Okay, folks, get ready for Sunday Night Futures Live with the Contrarian Trader, where we don't just predict the market, we trade it. So we have a lot to go over tonight. Last week was a explosive week in the equity markets. We're going to kick things off tonight with the futures action, and then we're going to talk about what kind of a market are we in. Are we looking at more downside in the equity markets? Was last week a capitulation in the equity markets? Was Friday that capitulation day? I'll give you the answer right now. The answer is no, absolutely not. So, hate to be a buzzkill, but that's the reality of the market that we're going to be trading in. The key is understanding the why. Why are we in this market? Because if we don't understand what type of market that we're trading, then we don't know when it's all safe to go back in the water. So we're going to talk about that tonight in great detail. So let me share my screen and we'll kick it off with the futures action. Before we go to the futures, folks, if you're not part of our forum, I already posted out stock chart requests for our members. Head on over. If you're not a member yet, it's free. No credit card required. I'm going to post the link in the description box. Head on over. And where's the chat? There it is. Okay. There's the link. Head on over. Enter your symbols right here. You can see we have a bunch already. I just closed it out. Okay. All right, so we got Franklin, we got Sean, we got Talon, we got Gay. Talon, oh, Baidu. Okay, good. Okay, so they're filling up. So hurry up. We'll max it out at about 10, 15. Depends upon how long we go. So let's get to it. Let's say hello to folks. First, I'll bring up the futures action. What you're looking at here are the E-minis. We're opening down about 0.75%. Not unexpected. Let's drill down here to a 5-minute chart. Now, what we want to see is on the 15-minute chart is whether or not we get a bullish reversal bar. And if we do get that, that could set the stage for a morning rally or an overnight rally. We left the day pretty oversold on Friday. A gap down would not be a shocker. I mean, it's the type of market that we're in. So you can't rely like you would in a bull market on an oversold condition leaving the trading day, resulting in a gap up the next morning. This is a different market. We're going to talk about that a lot tonight. So at the open here, we have the E-minis opening down, now down 0.70%. Let's go to the 5-minute chart. Let's bring up the NQ. That's the NASDAQ 100 futures. The NASDAQ 100 now trading at a 6-year low in terms of valuation, but still expensive. They are trading down at the open 0.87%. This doesn't look right. Yeah, I knew it didn't look right. So again, we want to set up an alert here because we don't know whether or not this is a liquidity flush. What does that mean? It means that you may have traders out there that want to buy stock, but they don't want to buy retail. They want to buy wholesale. So they'll know that a lot of traders have stops below new weekly or daily lower lows. And they're blowing them out right now, at least in the futures market. It's not going to matter in the standard NASDAQ, Dow Jones equity markets, not until tomorrow morning anyway. So NQ, we'll set up our alert. Let's check in with the small caps. Russell 2000 opening up 0.89%. Let me pause here. I meant to say hello to folks, and I didn't. Hey, Tim, welcome. Denny, welcome. The man, the mission, talent, with talent on loan from God. Tim, Bob, tomorrow morning will be real bouncing for the court. Yes, I was going to talk about that. Does a rise in general market after a big downturn come into play? Does a rise in the general market after a big? I wouldn't consider this a big downturn, Tim. I'm a big proponent of seeing capitulation. We have not had that yet. All we've had was really, if you take a look at the volume last week to the downside, it wasn't that bad. You didn't have really true institutional distribution last week. It was a down week. It was not a pretty week. It did not feel good, but you're going to know when it's the bottom, when you feel like the floodgates of hell are opening up, the market's dropping like a rock. The Federal Reserve has tried once, twice to try to salvage the market. The market's reacted positive, and all of a sudden they sell off really hard, just like back in 2020. So when you feel sick and the market's dropping down and you just can't take it anymore, that's when you got to buy. Simple as that. Jody, welcome. The lovely Jody. Franklin, good evening to you. Mr. Paul, welcome all. Okay. So it looks as though we have a little bit of stability here. No follow through on this new 5-minute bar, not 15-minute bar, 5-minute bar. Let's check in with the mid caps. Mid caps opening down just shy of 0.75%. Very, very thin volume here. It's not moving. There's no two-sided action whatsoever. Let's check in with the US dollar. Dollar gapping up. Let's check in with the euro yen trade. Euro gapping down here at the open. Yen moving up higher, gapping up, holding those gains. Do we get follow through? Both the dollar and the yen can move up together. The dollar euro trade moving up together is very, very difficult. Okay. Now, segueing from currencies into the commodity markets, gold gapping up here. Wow. It's not a shock. We're going to talk more about this in a moment. Gold gapping up just shy of a 0.5 percentage point at the open. I want to see what the calls are yielding. Selling them, not buying them. All right, I just threw out an order there to sell some calls. We're pretty extended on gold, and I will sell puts on any pullback. So what we're doing here is more of a contrarian trade, right? We don't want to sell calls when gold is down. I want to sell calls when gold is up. So we're selling strength. We're selling that call skew. And that way, when we get a pullback, which we will inevitably, we'll sell probably twice as many twice as many puts than we do calls. That's our business. Besides trading equities, we're not day traders, we're more swing traders. We like to sell premium and generating cash flow. Right now, gold is behaving very, very well. So we're throwing out an order to sell some call spreads. We have a protection on that. I would never go naked on gold right now. And we're generating cash flow. Hopefully we get a pullback after we get filled, and then I could sell some puts, and we'll have a neutral bet on gold with a slight bias to the bull side because that's the trend, right? We don't want to fight the trend, despite the fact that we're contrarians. Just because you're a contrarian doesn't mean you fight the trend. That's just stupid. Now, we have our order out on gold. Let's check in with silver. Silver up 0.29% at the open. So right off the bat, what this is telling me about the new trading week, equities down, gold up, fear trade. My guess is that we're going to look at the 10-year yield now, and the 10-year yield should be moving lower. And it is. Wow, this is a big gap lower. This is a big move for the 10-year, down 0.80%. That's a big move. So what that tells me is that the bond market tomorrow morning is going to scream up higher. This is important because we're going to talk about bonds as they relate to the yield curve in a little while. So remember this chart. If yields are down, bonds are up. This matters. We have a very large bond position. I want to go back to commodities. I want to check in with oil. Oil opening up about a 0.5 percentage point. We're long of oil. And this is another one I'm going to ask you to remember. These two positions matter, bonds and oil, because they have been the non-participants in the yield curve inversion trade, which I've been talking about for 2 years now. But it's happening. We're in the trade right now. So it's very, very important that everybody understands the correlations that are out there. So you want to see bonds moving up. You want to see oil moving up. You want to see nat gas moving up, which it is. Natural gas up nearly 3% at the open here. So all the trades that correlate with a yield curve steepening are happening right now, right at this very moment. And unfortunately, that means equities go lower. Let's take a look at protein trades, live cattle. I heard that the Chinese rejected a lot of our cattle, so they may be coming back over here. But I'm not seeing reflected. Let me go to the weekly chart. It's certainly not reflected in the price of cattle. Let's check in with wheat. I have an order out to sell wheat. I already have a position, but I need to sell more to hedge. There's my order right there. I'm looking to sell 20 contracts. Let's check in with corn. Corn on the week last week broke support. That's not good. So we may get a check back to around 456, 457, and then we're probably going to break lower. Soybeans opening down on the week. However, this is looking actually pretty good. This price action is of last week. This is a bullish key reversal bar on soybeans. It's a little bit frothy, but I think that a pullback here, this could be bought. Soybeans looking really, really good for the new trading week. Now, I know somebody mentioned Bitcoin. Let's go check out Bitcoin. Okay, so Bitcoin, I repeat this constantly for anybody that says that Bitcoin is the new gold. It is not the new gold. It is a risk asset, which is correlated to the stock market, opening down 2.26%. What's gold doing? Gold is up 0.18%. Okay, it's not the new gold. Bitcoin down, gold up, equities down, correlated with equities, certainly not correlated with gold. If with the new gold, it would be correlated with gold. All right, so I'm not going to get filled here right now. As a matter of fact, I don't like to pull back because that tells me that if we base, we could move a lot higher. So I killed that order. I wanted to get filled up here and then sell puts on a pullback. Didn't happen. What else did I miss? I get the feeling I'm missing something. Palladium. We opened up a position last week on Palladium. Here's the weekly chart. And you can see it's setting up really, really nice. So we like Palladium. It did not have a good day on Friday. There was Friday. But I think this is going to rebound and move up higher. We like Palladium. It has yet to run. All right, what am I missing? Volatility opening up about 3%. Now you can see that the first 15-minute bar, are we that far? Yeah, we're in the second 15-minute bar. So the first 15-minute bar, we broke through this upper band of resistance. Now, this second bar, we gapped down below it. That's a breakout point failure or a bull trap. Now, if we fail to recapture that resistance level, equities could rally overnight. I don't know what's going to happen in the morning, though. No clue. I want to see equities rally early tomorrow because I want to open up shorts. I'll get it right eventually. At or below. There we go. All right, I think we covered it. Okay, so let's get to it. Let's talk about the coming week. Now, the higher level view here is that we need to define our market. A bull market is one that is defined by higher lows and higher highs. A bear market is one that is defined by lower lows and lower highs. Now, you're going to hear on CNBC, you got to wait for 20% to call it a bear market. That's ridiculous. It's ridiculous. You're waiting for a label to decide how to trade. That's insanity. I like to keep it really, really simple. And by simple, I mean, we just do this. We take our crayon out and we draw trend lines. Now, everybody's heard of a double top. Now, this is what you call an overshoot double top, meaning we managed to put in a new high relative to the prior high. Now, even if we put in a lower high, this is the triple Qs, by the way, weekly chart. Daily chart right, weekly chart left, triple Qs. Even if we put in a lower high and we fail to take out the prior low, it's just a consolidation. You don't go shorting the index because, or stock, or whatever you're trading, cupcakes, it doesn't matter. You could chart anything until you get a confirmation breakdown. We got that. So here was the bull market. There you go. Beautiful. Could do no wrong. Now we are in, call it what you want, a correction, bear market, I don't care. I just don't want to be long. So do I think that this is going to break lower? Absolutely. Absolutely. And the problem is that if we break below the lows of the week of March the 10th, that would be a continuation breakdown, 466.64. And we would need to be looking at, my prior price target was 460. Since we got this rally and alleviated the pressure to the downside, my price target now is at around 450. That's a big change. So this is not a market that you want to be buying the dip. Not yet. There will be a time, not quite yet. Now, taking a look at the S&P 500. So again, overshot double top means nothing unless you get a lower high. Do we get that? Or means nothing unless we get a lower low. Do we have that? The answer is yes. We got that the week of March the 10th. We bounced back to check back to prior resistance. Now last week we began to roll over with a bearish reversal bar. So I would be shocked if we're not opening up tomorrow, or at least this week, seeing lower weekly lower lows. Now, moving on to the economic data coming out this week. Remember what's happening. It was just already mentioned. You're going to have rebalancing of portfolios. It's going to be a very, very volatile session tomorrow. Even on Tuesday, it's going to be volatile. It's going to be the beginning of the month. Many fund managers, if they have a big batch of losers, guess what they're going to do? They're going to sell them tomorrow so they're not on their quarterly statements when they send them out to their investors. So they're going to sell those stocks, and they could be buying them back in the next few weeks because tax laws. They can't buy it back for 30 days. So they have to wait 30 days. So if you have weak stocks that are out there, you should probably expect for them to get weaker tomorrow because of tax loss selling. Now, Tuesday, Fed head, doesn't matter. S&P manufacturing PMI, that is back in contraction. Any read below 50 is a sign of contraction. Construction spending coming out as well. ISM manufacturing, 49.5. Job openings. Watch this number because that's a precursor to unemployment. If you see job openings contract, then in the future months, you should expect to see layoffs begin to move up higher. Now, if it's ADP employment report on Wednesday, that means Friday is the pimp Mac Daddy of all economic reports. That is non-farm payrolls. So ADP on Wednesday, factory orders on Wednesday. This should come in with a beat. Because ahead of tariffs. Thursday, initial jobless claims, that's a weekly number. The trade deficit, nobody cares about that anymore at all. They used to. This is what Black Monday was all about. ISM services. Friday, non-farm payrolls. Watch out for this number here. Average hourly earnings. Oh, we get a kicker. Jay Powell speaks on Friday. So it's setting up to be a very, very volatile week. We're already seeing it in the pre-market action. Earnings, nothing really to speak of as of yet. This will be the end of Q1. No need to spend any time on this chart, nothing worthwhile. Now, where are we at in terms of the stages of a bubble? And we are in a bubble. I think that we are around here, where we haven't really had the big drop yet. And this is what I was looking for in early March. It didn't happen. And so I thought that we would get a more of a stronger move up higher. It didn't happen. That's because we didn't get the washout. So I'm torn about where we're at right now, but I think we're right. If I could draw a box here, we're right in this range, and we're setting up for the big sell-off. So I'm very, very confident that that is coming very, very soon. Because when you take a look at the multiples, even after the selling that we've seen so far, the Shiller PE ratio, which is a rear view mirror look at valuations, is at 34.75. It's still a very expensive market. And when you take a look at the S&P 500 or SPX is expected to report year-over-year revenue growth of 4.2% for Q1 2025, which is below the estimate of 5.1% on December the 31st. So revenue growth expectations are declining. Off of FactSet, analysts have decreased Q1 EPS estimates for SPX companies by 4.1% since December 31st. So you have revenue guidance going lower since December 31st. EPS guidance, earnings per share guidance, going lower since December the 31st. And all the while, you have the equity market, which is very lofty. So people have to, if the strategy is for people to hope that companies are going to grow into their valuations this quarter, that's not what the analyst community is saying right now. They're expecting weakness in earnings and revenue growth. So if the bet is right now that companies are going to grow into their valuations, strategy is not hope is not a strategy. So please, there's nothing to conclude that companies are going to be growing into their valuations this quarter. Add to that, you had so VIX just moved lower, a lower low on VIX. That tells me that we're getting a little bit of buying in, this is the S&P 500. Not really doing much, to be honest. 15-minute chart. It's stabilizing, not capitalizing on that drop in the VIX. And VIX doesn't look like there's a lot of selling behind it either. Let's go to a 5-minute chart here. Okay. Nothing happening. Okay, so Atlanta Federal Reserve, GDP now. Back here in February, they had the target for Q1 GDP at about 3.5%. Now, latest estimate, negative 2.8%. Negative 2.8%. So what the hell is going on here? What's going on is that you have behind the scenes, you are having the 4D chess match of the century. The United States in 2025 needs to refinance $9.2 trillion worth of debt. It's expiring from near 0%. Now they're confronted with having to refinance $9.2 trillion in debt up to 4%. So they need to knock the markets down to make the Federal Reserve intervene to bring down rates so they can refinance all that debt. This is a major problem that nobody wants to talk about except here. This is where we talk about this stuff. This is the Wizard of Oz behind the curtain. This is what's going on. So we have a tremendous problem with refinancing our debt. And it's happening very, very soon. Now, the other issue out there is tariffs. Now, I want to be on board with the tariff plan. I really do. I want to be on board with it. But what I'm not hearing from the Trump administration is what the tax system looked like before 1913. And three things happened in 1913. Actually, four things happened between 1909 and 1913. In 1909, you had the 16th Amendment, which was passed. That was the income tax. It was ratified in 1912 or 1913, and that's when they created the Federal Reserve, the IRS, and they instituted the income tax. So I plugged this into Grok, which is the chat GPT for Twitter or X. And here is the revenue for the United States prior to it. Remember, this was the heyday of industrialization in America. So federal revenue max was $690 million. Individual income taxes, zero. Corporate income taxes, zero. Social issuance tax, I don't know what that is. It's not the Social Security tax. I guess it is. Because it's zero back then, and now it's 36%. Tariffs, 50% of the revenues that came in were tariffs, but there was no income tax. So while the naysayers of tariffs will say that tariffs increase prices, therefore increasing inflation, they're right. They're absolutely right. Tariffs are going to cause prices to go up. Maybe not as much as what the tariffs are. Let's say we're going to increase tariffs by 25% on European autos. That doesn't mean that tariffs are going to, a cost of autos is going to go up by 25%. It means that they'll absorb some cuts, but prices are going to go up, no doubt about it. Now, the offset that we had in 1913 was no income tax. So you take away the federal income tax from me, and I'm good with the tariffs. Raise those prices all you want. I don't have to spend. I'll buy American. And I'll keep those taxes that I was paying to the federal government. I'll stock that away. But we're not hearing that. We're not getting that. And I think that at this point, with the tariff talk, if they're serious about it, they need to start talking about tax cuts, big tax cuts, not 10%. I'm talking about the AMT, alternative minimum tax, abolished, or at least raise the limit up to $1 million, $2 million per year. Right now, it's at $150,000. I mean, it's a joke. So this is the problem that is not being articulated. That, yeah, tariffs are not great when you have an income tax. Get rid of the income tax, or at least cut it in half. You're going to have to do something really, really big to offset these taxes. That's why I believe he's not necessarily all that serious about the tariffs. I think that he's looking for these companies such as Hyundai, that's the Japanese yen, Hyundai, which is investing $20 billion in the United States. They're going to have them move their factories here. In fact, Hyundai is building or buying a steel mill in Kentucky, and they're going to produce the steel for their cars here, plus a whole lot of other stuff. So there's a lot of question marks about what's going on right now with the tariffs, and the markets do not like uncertainty. And one certainty that is out there is that the Federal Reserve is Nowhere around to help out. Expectations for a rate cut in May, really non-existent. June, 76.7%, maybe. That's a couple of months away. July is probably the best guess. That's nearly up to 90% again for a rate cut. Now, earlier, I was talking about the yield curve. And the yield curve is when I haven't gone over this in a while, is when the 2-year yield reinverts, crosses back above, the 10-year yield crosses back above the 2-year, and rates begin to normalize. We had an inversion of the yield curve where we had the 2-year yielding more than the 10-year, which is nuts, but it had been that way for a couple of years. That is now being undone. Now, when this steepens, I have this red for a reason, because in the past, 2020, financial crisis, and 2000, that's when you get bad things that happen in the stock market. 2000, we know what happened. Here was the S&P 500. You don't want to see what the NASDAQ look on this chart. Here was the financial crisis. We rolled over. Here we are now. This has just begun. Gold is doing what it's done in the past. It's ripped up higher. Just a couple of minutes ago, we went over it. New all-time record highs for gold. Natural gas, moving up higher. Natural gas is in fuego right now, moving up higher. Bonds, the only laggard in the past, I'm sorry, not the only laggard. I retract that. In the past, bonds have been the go-to. People sell stocks, they buy bonds. Simple as that. They haven't been doing that. They started on Friday. I think we're going to get followed through. We saw it in the futures action a little while ago. That's why I asked you to remember the drop in yields. That means a rise in bond prices, and oil prices have yet to break out. But we put on a long bet last week that oil is going to begin to break out as well. So when we look at this chart, when I look at this chart, and I have to divine with only one trading day left to go in the month, where are we going to from here? We're going up. This is going to continue to steepen until we get Federal Reserve intervention in the equity markets. And right now, we hear crickets. But I'm going to tell you in a moment what I think they're going to do in the coming months, if not weeks. Here's a chart of the TLT, the bond fund. We own it. I own a lot of it. And this is, we're just parking cash here right now. It has lagged relative to prior times, but last week, while we were down on the week, we bounced off the lower band of support, recapturing another one. I think that this presses up higher. Now, as far as the consumer is concerned, I have a couple of charts to go over here, and this is another reason why I think that the equity markets, the path of least resistance, is to the downside. Vehicle seizures in the United States are skyrocketing. Car repossessions hit 1.73 million in 2024, the highest since 1.77 million in the Great Financial Crisis. Car repossessions means a lender legally takes back. We know what it means. So they defaulted on their loans. So loan defaults in autos are screaming up higher. It gets worse. This is from, well, it's not Michael Burry. It's a fake account. 6.1 million Americans, this is a Bloomberg number, 6.1 million Americans are behind on their mortgages. FHA delinquencies just hit 11%, the highest in years. So we're seeing delinquency rise in autos and in home loans. And the problem with that is that junk bonds, corporate bonds, high yield bonds, as they like to call them, they're beginning to roll over. So credit tightness is beginning to tighten up. And these companies that have to issue these bonds at pretty high rates, they're going to have to pay out more on their interest on that debt. What does that mean for their stock prices? It goes down. And anybody exposed to those companies has got a problem due to the fact that they're going to have potential ongoing concern issues. So it's critical for the administration to get yields lower, to take the burden off the consumer, to enable the federal government to refinance its debt. We don't see that anywhere yet, with the exception of the markets now beginning to jawbone yields lower, but without the help of the Federal Reserve. That's probably a good thing. But for consistency, you would want to see the Federal Reserve providing that Fed put. Without it, I can't see a sustained rally in the equity market. Now, what I think is going to happen here, and I have gone over this in the past, this is the Fed's balance sheet. And the Fed's balance sheet has continued to, let's go close up here, has continued to drop off dramatically. So what does this mean for you as a trader? It means that the Federal Reserve is not cutting rate. They're running off rate. They're not cutting rates, and they are continuing to roll off debt off their balance sheet. They're not buying. If they were buying the debt, rolling over the debt, that would allow yields to drop because the Federal Reserve is in there providing liquidity. They're not doing it. They're providing supply right now. That's pressuring yields up higher. So I think that in the coming weeks, we heard 2 weeks ago President Trump throw a bomb at Jay Powell through the media about cutting rates and doing so quickly. We haven't heard anything since then. I suspect that what's going to happen is that one night we're going to pull up this chart and you're going to begin to see a pattern develop. And that pattern development is going to act like this. This is going to start to flow sideways. There will be a pause, but you'll find a base being established. I thought we were beginning to see it back here. Didn't happen. It just continued to roll off. You'll begin to see a base build, much as you would on the base of a stock. And then you're going to begin to see it climb. We'll be watching out for that very, very carefully. That will be the Fed put. Because with inflation still on the rise, they can't cut rates. They can't do it. Not with tariffs technically being inflationary. And you had personal income last week, which came out hotter than expected, like twice as much. The only good part was that spending was down. So you don't have the demand for supply. People trying to pay down debt, building their savings, they're afraid. So they can't cut rates yet. They don't know what the tariff picture is going to look like. They know what the tax picture looks like. It looks like hell. Now, in terms of capital allocation, I mean, it's simple, it's clear, it's defined. You need to be in things that drop on your foot, hurt. You need real things. Gold. This is a monthly view up 7.89%. Great chart. What makes this chart not just look great, but look spectacular is when you create a ratio chart. Here, gold relative to the S&P 500 year to date. Gold is outperforming the S&P 500 by 23.5% this year alone. And if you think that's bad, take a look at this price of silver on the year, up nearly 17.75%. And this is just getting started. You could argue that looking at the price of gold on a yearly time frame, we're getting a little bit frothy. We're getting a little bit extended. Doesn't mean that we're going to pull back. I mean, hell, we spent almost a year trading up and into the third standard deviation Bollinger Band back in the 2000s. So here we are yet again. But silver is just beginning. We made a killing on silver last week. So silver looking great, gold looking great, stocks not where you want to be. So that's the market in a nutshell, folks. And there are a lot more question marks than there are answers, and the markets do not like indecision. Therefore, the path of least resistance for the equity markets right now, unfortunately, is going to be to the downside. Rallies will get faded as this past rally was, and we're going to begin to break down to new lower lows. It's as simple as that. So I wish I was more short than I am right now. I covered shorts. Now I need to look to reestablish them because I had hoped for a bigger capitulation sell-off early in March at which I could buy equities, and it didn't happen. And we pooped out a little bit too early for me to go shorting stocks. So I'm kind of playing catch up here myself, but we have a lot of capital on the sidelines because there are going to be great buying opportunities. The key is right now, if you're on margin and you're hoping that this market's going to bounce back, consult your financial advisor because it's not a good place to be. Your broker, if you're on margin, is your senior partner. They will do what they call forced liquidation, or they can raise their margin requirements overnight. So you may be only levered by 30%. Well, if they raise margin requirements by additional 10% overnight, well, guess what? Now you're up at 40%. If equities drop lower, then all of a sudden you're into it for a margin call. Lighten up on the margin. At least do that. If you're young, dollar cost average all you want. It'll come back. Let's say hello to folks that just joined in. Mr. Pat, still in Tennessee, Pat? He's buying cattle. Bonnie Bean, welcome. Jody, is the rut going to follow SPX or be more or less extreme? To the downside, it's going to be probably more extreme because of liquidity concerns. Remember, most companies in the rut aren't making money. There is a fund out there that I invested called, I'll get the symbol, I'll share it one night. It's the S&P 500, S&P 600, and those are the companies that are making money in the small caps. And that's how I would approach that trade. I would dollar cost average into not the IWM, but I would dollar cost average into the funds of the stocks that are in the small caps that are making money already. In Connecticut now. God bless you. Okay. Let's do some chart requests. Hey, folks, the chart requests are brought to you by our friends over at TrendSpider Automated Technical Analysis, and I can't say enough about them. Way too many features to go over here. Automated trend lines, and if you're an experienced trader like me and you don't think that you need automated trend lines, think again. I still do my manual trend lines many times. There are times where I'll draw my manual trend lines and then I'll overlay the automated trend lines and I'll see whether or not I'm on point or did I miss something. Sometimes I miss something. It's good to have somebody that tap you on the shoulder and say, okay, look at what you may have overlooked here. And that's what this algorithm provides you. Awesome functionality, chart patterns, heat maps. I mean, just so much. It's ridiculous. There's a link below. Get minimum 35% off on YouTube, 35% off on the link above on Twitter. Head on over. And I give it away free to our silver and gold level members. And I give you a 14-day free trial offer. So take advantage of it, risk-free. TrendSpider, good partners of ours. And we love them. Okay. Let's go over, take a look at what we're going to be looking at this evening in terms of our chart list. Let me do a refresh. And we're going to begin it off with Mr. Talent. Let's get the drawings off as well. Talent KMI. Kinder Morgan, great yielder. What is this yielding now? I used to own this years ago. 4%. 4.05 to be specific. Okay, so this is the auto Fibonacci's. You can see we topped out back here, recaptured this Fibonacci retracement level. And I think we need to touch back here, do a retest. 2781, I'm a buyer of Kinder Morgan. The trend, it's clear, it's defined, it's up. You have a whole, this is the automated trend lines. You have a whole bunch of resistance up here at 31.61. Let's go to a monthly chart for a moment. So monthly chart, one trading day left to go. We have a monthly breakout here. This wants to go up. I think we are going to get somewhat of a pullback, maybe even a retest of this breakout point, 27.31. But I think ultimately this gets resolved to the upside, especially if economic growth begins to pick up. Pick up. A little bit of a topping tail last week. I would definitely wait for that retracement back down to support, and I'd be interested in it back at that level. Daily chart looks bullish here. Rebroke out. I want to see it back down here. May not get it. I wouldn't chase it, though. It's optionable, probably thin market, so you could sell puts if you want to get long at a cheaper price. For Gay, we have Baidu. So the Chinese stocks have really stalled out here of late. This is a weekly chart. And you can see that we rallied up and into resistance. We were rejected. Rallied again last week. We were rejected. My guess is stochastics have rolled back over here again. They're threatening to roll over. They haven't rolled over yet. What's the daily chart look like? Yeah, we have Stokes trading down below 50 on a daily time frame. So one saying that I always use, because I never regret using it, is that when you have your stochastics, which are a momentum indicator, trading down below 50, rallies tend to fade. Rallies fade. I'm probably going to have T-shirts made up that rallies tend to fade when your Stokes are trading down below the neutral mark at 50, and that's sure as heck what happened here. We rallied, pulled back, then we got a bear flag setup. We gap lower. This is probably going to do a check back and then fail, roll back over again. I don't think that you're going to get new lower lows, 52-week lows. I think that right now you're just in a trading range on Baidu. You need to wait for a better setup. This is not a good setup to get long yet. If you start pulling back to support levels, this is the automated trend lines, back down here to around $87. That's interesting. That's entirely feasible. You have Fibonacci support at around 91. You may want to nibble at these price points, but notice how we're rejected right at this Fibonacci retracement level here. I don't have the percentages that these are, but Fibonacci resistance immediately above. So right now, this is one where if you want to buy it, I would sell deep out of the money puts, because if the U.S. equity market goes into free fall, so shall China. China is not immune to our equity markets. So be careful here. I'm fine with selling puts. You may want to sell a call as well. That way you're offsetting your risk a little bit, but that's how I would play it. I would not buy the stock yet. And I would put my strikes below these support levels. Me personally, I'd be looking at around $85 strike on Baidu going out 30 to 45 days. Soundhound, this one really got hurt. I think it's back down below 10. Yeah, well below 10 now. We're at critical support on Soundhound. I certainly wouldn't short it, but I have the feeling that we are probably going to press lower here. I mean, this is a major rejection last week at that $10 per share mark. Actually higher than that. $10.50. Critical resistance. Now, if we were to get an overshoot down between 744 to 644, that would be interesting to me. Now, if we hold this for a couple of weeks and the markets begin to stabilize, then we revisit it and we decide, okay, maybe it's safe to go back in the water. Right now, with this price action, no bueno. The only thing I must say is that the down volume has been very, very light. Very light. Is that it? I think. Oh, no, there's more. I knew there was more. Sean. Rumble. Weekly chart. Stokes trading down below 50. Rallies tend to fade. What happened the past 5 weeks? They tried to rally it, fade, rally, fade, rally, fade. It's the same old thing. So this type of setup here is, the analogy I like to use is Lucy pulling the football away from Charlie Brown. So if you see these stocks up midweek and you have stochastics trading down below 50 and declining, you end up at the end of the week with on your back because you bought, because the weekly chart looked good on Wednesday, but then on Friday it looked like death. So I would strongly encourage that you wait for a support level at which to trade off of, and I'm looking at 623. I want to see an overshoot back down to where you have buyers of like mind willing to step in and help support the stock. You have support right there as well. This is the automated trend line at $6.35 on last week. I shouldn't say on Friday. Last week, we broke through the final Fibonacci support level. Daily chart. Again, we broke Fibonacci support. We're coming down to, I think we're going down with a 6 handle. I wouldn't touch this stock until I saw a 6 handle. You may be saying, well, the support at $7 per share. Yeah, I want to see an overshoot down to a 6 handle, and then I want to see a bullish reversal bar closing back above 7. That lets me know, and I want that to happen on volume. That lets me know that, you know what, we have a short-term bottom here, then I can enter it for a trade. Until we get that, path of least resistance remains to the downside because this trend is clear, it's defined, it's down. QQQ. We kind of already went over this, but we'll go over it again. It's worth the conversation. I want to go to the monthly chart here for a moment. And I want to talk about how we are poised to close out the month. Now, I have support levels previously drawn here. We are at critical support. So on the month, we have smashed through two major support levels on the triple Qs. And we're poised to close at or potentially below another one. So there's my upper band of resistance. Probably too soon to draw this. Yeah, it's definitely too soon to draw this. I don't have enough data here. But we may get a rally in the beginning of March, bringing us up to around 483. And then I think they tank it again and they finally break this. But we're going to have volume. I want you to take note also of the volume on the month so far and the fact that you have momentum is measured by stochastics. Putting in lower highs. And now lower lows. So momentum is now building up steam. Doesn't mean we can't get a counter trend rally. I hope we do because I want to short into it. But I think that ultimately this gets resolved to the downside. Why? I went over a host of reasons why. And when people ask me when we see sell-offs, you think that this is the bottom. And I ask this of myself as well when we have a nasty sell-off day like we did on Friday. I always go back to what's changed. I always ask myself the question, what's changed? Do we have a question about tariffs? Yeah, we do. Do we have an expensive market? Yeah, we do. Is forward-looking guidance on revenues looking poor? Yes, it is. Our EPS growth, is it declining or expanding? It's declining. So this has the potential to get worse this quarter, not better. That's what concerns me. Not to mention that you have the Atlanta Federal Reserve predicting that the economy is going to contract. And when you add into that the fact that you have delinquencies moving up in autos and homes, yet people are making more money, yet they're not spending it, that's all the makings of an economy that is grinding to a halt. So we want to acknowledge it and respect history. And the history of situations like we're seeing right now are clear and they rhyme. Money right now is flowing into where it traditionally does. Gold, natural gas, bonds beginning to. They are putting in higher lows, no higher highs yet. Oil, not yet. But stocks are clearly rolling over here. And the yield curve continues to threaten to move higher. That's a tightening of liquidity. So let's just be careful out there. And if you're on margin, patience. Get off that margin. Folks, thanks for being here. Let's go do a roll call. Jody, you're very, very welcome. Thank you for being here as always. Hey, Jeff, welcome. Mr. Sean. I got a guy for you for the shirts. Yeah, let me know. You're welcome, Gay. Folks, have a profitable trading week. Members, I'll talk to you tomorrow. Don't forget, TrendSpider, link below on YouTube, 35% off. Link below, link above on Twitter. And I give it away free to our silver and gold level members. Thanks for being here. Have an awesome night. Be well. Do.